for me to do this presentation is also that a lot of folks in my network have been asking me, is this a right time to buy real estate? Because if you go to the MLS listings for some of what were traditionally the hot properties, cities like Atlanta, Austin, North Carolina, cities in North Carolina, the prices have been decreasing over the last couple of months. So that's one thing. And then also, we have seen that the interest rates have increased significantly over 2021 and 2020, the COVID years. And there is this general concern, maybe I should just wait it out and see, when the interest rates come down, when the prices come down further, then maybe that's a good time for me to buy. But just like in stock market, Daniel, when you're a contrarian investor, that's when you can make significant gains, whether it is in the stock market or whether it's in the real estate market. So I feel that this is an essential skill, especially when you're starting off, to figure out whether, what is the right price that it makes sense for me to offer on a property. And so that's the main motivation why I wanted to do the session. So thanks for joining. You made yourself here, made yourself available here on a Saturday morning. So it really goes to show that you are really interested on getting started on this journey on a strong footing. So all of you shared the cities where you're in your real estate journey. I'd like to know what is your motivation for investing in rental properties? So when I ask this question, these are some of the feedback that I get from folks. So the first one is they want to gain financial freedom, either to retire early or to pursue their passion projects full time. So that's one thing that I hear. Few folks want to supplement their retirement income. So when they retire, along with their 401k proceeds, they want to have a more assured income from their rental properties. So that's the second reason I hear. The third one is folks have heard that, investing in rental properties is a much more tax efficient way of building wealth. And that's why I want to do that. And the fourth one is while they're working, they want to create another passive income stream. So that's why they are looking to invest in rental properties. And then the last one is to build generational wealth. So there's also, if you have looked into this, much more, the structure of investing in real estate makes it easier to pass the wealth to next generation. So building the generational wealth. So if you can get into the chat pod and then share what are your reasons for why you're looking to invest in rental properties, that would be awesome. Chat pod. Okay. Okay. That's awesome. What about you, Shiva?
I don't know how, but it's going a direct message to Daniel. But I'm looking on this path because of additional income source, a part of what we regularly do.
So that's option D.
Yes.
Okay. Let me do a quick stop share. I think what's happening is that when I go to the chat pod, I'm not able to do the slide show at the same time. Okay, cool. All right, so let's move on to the next one, which is unless you have just started in 2023, if you were starting to look at investing in rental properties in 2022, I'd like to know what are some of the factors that prevented you from investing in rental properties in 2022? Was it because you were waiting for a price correction? Or was it because you perceived the interest rates to be high? The down payment was high, and that's why you didn't have the funds. Lack of knowledge, you didn't know where to start, or you made several starts and stops, you lost momentum along the way. Yeah. Got it. Okay. All right. What about you, Shiva? I think in the chat pod, what you have to do is, how you have this direct messages. If you say everyone in the meeting, then you'll be able to send it to.
Yeah, for some reason, I was unable to change that. I don't know why. It says
You're
only.
not able to change that.
Yeah.
Oh, okay. Okay. Sorry about that. So you can give your answer.
I'd say D.
D, which is not knowing where to start.
Yeah, correct.
Okay. Okay. Wonderful. That's the benefit of having a small group here, that I'm able to get responses from all of you. That's awesome. All right. So one last question I have is that, what's the first feeling that comes to mind? So if you just close your eyes, think about, okay, if I were to realize my rental property investing dreams, how would I feel? What is it that comes to mind? Is it peace, joy, pride? You'll feel more confident, you're more relaxed?
Confident.
Okay. And the rest of you can also share, or otherwise put it in the chat. But actually, we'll do a go round. Share, Yuvan, what was your response? Rather than switching to chat, I can hear from you directly.
Yeah, definitely confident, but at the same time, there are lots of mortgage, so probably will a little bit anxious about the upcoming, long mortgage.
Okay, so along with confidence, there's probably a level of small amount of stress is also probably what you anticipate.
Yeah, kind of.
Okay, okay. Daniel, what about you?
Every peace of mind for me, I guess.
Okay, and peace of mind because real estate market is not as volatile as stock market?
Yeah, I mean, it would be probably, the ideal scenario in my head is like you get a rental property, you cash flow it, and then you have a peace of mind that, there's something like a nest egg building up on its own without much effort. That's my expectation from, having decent real estate portfolio.
Yeah, yeah. Jung, what about you?
I think I'll be a little bit more relaxed because I think I'll be more diversified then.
Yeah. All right. Awesome. No, thanks for sharing that feedback. So now I want to share a little bit about myself. So as you all know, I'm a full-time working professional. I'm a mom, and I'm also a real estate investor. So it was in 2002 that I became a first-time accidental rental property investor. So this was the year when I was moving out from my primary residence to pursue my MBA in a different city. And at that point, we had a question of whether we want to sell that primary residence. We were living there for a little over 2 years or a little over 3 years then. But then we decided that we don't know where we will end up after my schooling. So why not continue to have it as rental property? So that was the first time. And then I continued to be an accidental investor for a really long time. So it was my work, it was my family. I have 2 boys. And then it was until very recently that I started to look at investing in rental properties much more intentionally. So maybe for the last 3 years or so. And right now I invest in single family homes as well as in small multifamily. So that's where I'm at. But even being an accidental investor for so long, what I'm really surprised to see is that when I look at my net worth, 50% of the net worth actually comes from my real estate investment. So just imagine that if somebody who is starting on this journey, 10, 20 years before, when I started, when I first became an accidental investor, if I was more conscious about it, it would have been much more better for my family for sure. So that's why I'm hoping that with these kind of sessions, I can motivate more number of people to take advantage of this. When I say this, I mean real estate investing. And my primary goal, Jung, was very similar to you, which is how I enjoy working, but at the same time, I like building wealth too. So how can I get that financial freedom while I'm continuing my professional career as well? All right. So today there are 3 topics that I want to share with you. The first one is how to evaluate deals. The second one is how can you track your progress? And the third one is how to spot an investor-friendly realtor. Because as you're starting on your journey, on your real estate investing journey, I think these are the 3 aspects. Think about it as 3 legs of a stool that will really set you up well. So I touched upon this about evaluating deals and why it is important. So when I think about the way I approached it earlier, when I was getting started on being an intentional investor, is that I was spending a lot of time endlessly scrolling on MLS listings, and in a session of an hour, if there were 10 properties that caught my attention, that would really overwhelm me. And I would jump from one city to the other, looking at properties. And then at the end of that, it's like, okay, I don't know how to decide which one I should proceed with. And having this framework of how to evaluate a deal will really help you break that overwhelm and go to the next step of, okay, shortlisting the properties and then take it to the next step of sharing that listing with your real estate agent. So the second one is, I strongly believe that whenever you're making decisions like investing in real estate, where unlike a stock market, right, where you can open an account and start investing with just $100, $200, in real estate, it takes a significant amount of down payment. So unless you have a buy-in from your spouse or your significant other, it becomes extremely challenging to get momentum, right? So when you evaluate a deal, that also provides you another data point. You can share your thinking and why that property is interesting with your spouse or significant other. So I think that makes a lot of difference. And the last one is over a period of time, as you are keeping tabs on evaluating these properties, you just become a smart investor. So you are able to, the process becomes much faster, and you'll be so much closer to your goal of, I'm not just looking at deals constantly, but I'm actually making progress towards buying that first investment property. I'll pause there. Any questions? Okay. All right. So here is the what I use, a quick deal analyzer. And we'll go through a live example to see how I use this. So the beauty of this is that you can just spend 5 minutes on this and look at a property and then figure out whether it makes sense based on the list price, whether you should make an offer, or what are some of the things that you can tweak so that you can come up with the right offer price. So that's the idea here. So I'll start with the left-hand side of the spreadsheet. So what I have here is the property information. So this is an investment property that you're looking to buy, and you're hoping to get some rental income out of that. So as a first-time investor, when I became the accidental investor, right, that I was sharing earlier, my only metric in mind was, does the rental income cover by my mortgage payments? That's it. And if it was sufficient, I thought that yes, that's good enough, right? And it makes sense. And over a period of time, I'll gain equity, and everything will be okay. But there are few, if you approach it this way, you'll have a better sense for what the cash flow looks like. I'll walk you through these items. So the first one is, very obvious, your rental income. And I have this additional income sometimes depending on the situation of your investment property, or sometimes you can get income from your pet rental income also. So there are opportunities to add that additional income. Then there is vacancy. So as a first-time investor, one of the line items, and vacancy tends to be that, we tend to forget is that when you're looking to rent a property, there will be churn. The tenant moves out, and it might take you 1 month. It might take you 2 months for you to rent out that property again. So definitely take vacancy into account. And that gives you your total income, and expenses is another line item that we tend to forget. So that's another thing that you have to remember, where you're paying property taxes. Property taxes is a big line item that people forget. So when you're taking a mortgage loan, some of the banks, they include the taxes and home insurance. Some of them don't. So you have to be extremely cautious about that. And then make sure that you're accounting for your expenses that you have to pay for the property. So that gives you your operating income. And of course, mortgage is a payout that you have to make, and that gives you your cash flow, right? So this is at a high level, the property information. And like I called out here on this deal analyzer, all you have to do is make sure you have enter the line items that are in blue, the cells that are in blue, and everything else is automatically computed for you. And now when you move into the right-hand side, this is about your financing. And here you have the purchase price of the property. And then you figure out how much of debt you're paying down. And then these are the last two items are your loan terms. Here I have a typical 30-year mortgage loan is very common for a single family home. And the interest rate and the loan term. So if these are the two cells that you fill, then it spits out a mortgage, what's the monthly mortgage, and that's what is automatically filled here. So that is at a high level, the details of the deal analyzer. So again, just to highlight, there are 5 values that you're filling in, and then rest of it is automatically computed for you. So with that, let me share the link with you all in the chat pod. So this is the link to the deal analyzer. And as I'm going through it, you can actually do it also along with me. Oh, yeah.
Shalini, can we ask a few questions here?
Oh, absolutely. Yeah, go ahead.
I'm curious about the vacancy. What does that actually mean? How did you come to this number? Is it a portion of the monthly rental income? Or
Yeah.
is it, like, if the property sits idle, right, you'd have to still pay the mortgage, not generating any income at that point.
Yes. But so what is your question then?
How did you come up with that $150?
Oh, so that's automatically computed. So what I said is that the vacancy is going to be 5%, approximately. So typically, if you look at, it tends to vary from market to market. But if you look at vacancy rates, 5 to 7% is something which is common.
I see. Thank you.
Yeah. So I have a deal analyzer here already open. Get rid of that. And I have, so let me go back to that. Okay, so if you want to walk along with me, so end of last year, I bought a property in Austin, and this was in the Anderson Mills area. So if you want to walk along with me working on the deal analyzer, you can go to Zillow and I was looking at this property earlier. So I was, so you can just type Anderson Miller or whatever city that you're interested in. That also works. And this area was of interest to me because it is close to highways, close enough to Austin downtown, centrally located, and all that stuff. So, so one of the properties that I was looking at was this specific one. Let me zoom in a little bit more. So this was the property around 400K. So you're seeing this quite a bit in some of the markets. So the price drop, and this is listed at almost 400K. So what I'm going to do is look at this information. And here I have the deal analyzer open. So I'm going to plug in the numbers, 400,000. And this interest rate, I put it at 7.15%. This is the interest rate that I ended up paying. But then for your own situation, I would highly recommend working with your bank or with your real estate agent to point you to a mortgage broker who can give you, based on your situation, what the interest rate could be if you decide to buy an investment property. And the loan term, I put it at 360 months, which is 30 years, basically. So for the debt, I put it at 75%. What I've seen is that for investment properties, okay, let me step back. For primary residences, you can actually get away with as less as 80% or 20% as the down payment and 80% in debt. But for the investment properties, typically banks request a higher down payment. So that's why what I've seen, 75% is the minimum. So that means about 25% in down payment. So play around with this to figure out, if 75% is okay, you want to pay down a little bit more to bring down your mortgage payment, that's also fine. So as you can see, if I put 75%, the mortgage payment with these interest and the duration of the loan, it's about 2,000. If let's say I'm willing to pay down 30%, which means that only debt of 70%, the mortgage payment comes down a little bit low here. So I'll switch this back to 75%. So that's the information about financing. And here, to calculate the rental income, just in the interest of time, what I do is here is the zip code of the property. So if you go to Zillow, you have the buy as well as you have the rent. And here you can actually enter what is the zip code that you're looking for to rent. And based on the property that you just looked at, so in our case, we were looking at this property. You have the rough square footage. It's about 1,600 SFT, and it is in this zip code. And look at the year, and the configuration for this is a 3-bedroom, 2-bath. And this is a 3-bedroom, 2-bath is also a very attractive configuration for rental properties. If you go for more number of bedrooms, then you're probably not getting the ROI in terms of the price that you're paying and the tenant pool that would find it attractive. So this configuration is something that I like. And there's also, I forgot to talk about the filters, right? So you probably know all of this information, so it'll be just a repetition. So for this one, typically I am looking at what are the exact number of bedrooms, what's the bathrooms. I'm looking for single family homes. And also one more thing that I look at is I try to find properties which do not have a HOA. So that way you have enough flexibility. If you want to change exterior, interiors, you have flexibility to do that. So those are some of the filters that I commonly use. So going back to the deal analyzer, how I get the monthly rental income is in Zillow. And Zillow, by the way, in the last year or two, it has become the go-to source for prospective tenants. So they have really invested quite a bit on their rental platform as well. Earlier, they used to emphasize more on listing the properties for sale. but now they have become that has become the primary source for a lot of property owners to where they get their tenants from. So what I'm saying is, yeah, this is a good place to actually get for that zip code, for the house configuration that you're looking to buy. What is the potential rent that you could get? So you see that here again, for rent, you can select your property configuration that you're looking at, and then home type, you can just for select houses and you can say apply. So it gives you a few properties. So you can see that, look at this one. This is listed at 2.2. It is about 1500 SFT, which is similar to the property that we just looked at. And if you look at this one, again, a 3-bedroom, and it's 1400, even more less, 200 SFT, which is almost the size of a room. So looking at these numbers, you can probably say that, let's look at this one. Yeah, 2.4, it's slightly bigger at 1700 than what we looked at. Yeah, this is again something more closer to our the house configuration that we just looked at, right? So you can, my sense is that properties in this area probably rent somewhere between 2.1 to 2.3 for the configuration of the house that we just looked at. So if I'm feeling optimistic, I'm going to put this at 2300. And if, let's say, you decide to allow pets, for example, you can put some income. Otherwise, you can just set it to 0. And this one, based on my response to Daniel's question, typically the numbers tend to be about between 5% to 7%. So I put it at 5%. With expenses, with single family homes, typically the tenant is taking care of all the utilities also. So as an owner, you are basically taking care of any maintenance and repairs expenses. You're taking care of course, your mortgage payment. Mortgage payment comes next anyway. Yeah, any repairs, taxes and insurance. So those tend to be the other expenses. So that's why the expense numbers, you can probably go to as low as 35%. And there's one more thing, a function of the age of the property. If it's a much more recently built property, then your expense ratio could be lower. But if it's older property, there are more chances of repairs and maintenance issues coming up. And also there's one more line item that I forgot about in expenses, which is property manager. So I highly recommend having a property manager. I know few folks in my network who work full-time and still want to manage properties by themselves, which is okay. But I just feel like, especially if you're a long distance investor, that reduces your headache quite a bit. So, typically for single family homes, depending on the size of the portfolio, if you're just starting off, you're probably paying somewhere around 9 to 10% in property management expenses. So that also goes into this line item. So, all right. So with these numbers, what you see is that you have a negative cash flow of 500. So what do you do at this point? So Jung, I'll ask you, if you see that there's this property, which is at 500, you have to put in $500 every month. What is your immediate reaction to this?
Maybe not.
Maybe not. Okay. Daniel, what about you?
I want to first ask the question. We don't have the insurance listed here, or is that part of the mortgage? Because I feel it's even more underwater than that. But
no, so the insurance actually, I made it part of the expenses itself.
Okay, got it.
Yeah.
All right. In that case, I would say you have to talk to the seller to bring down the price.
Okay. All right. Yeah. Shiva, what do you think? If there is this property that you like, but then if the cash flow is negative 500, what is your immediate reaction?
Probably I'll look around for other options as well. Like as Daniel mentioned, I would negotiate a little bit.
Okay.
Or if I really like the property, probably I'll go ahead with it.
Okay. All right. Yeah. So that's the first thing, right? So if you're thinking about, my criteria, so I'm not covering the purchase criteria in this session because it's its own lengthy thing. But then as you are evaluating more of these, you will have a greater appreciation for your criteria, your investment criteria. But what you're learning today will help you as you're doing more and more of, as you're evaluating more and more deals, then you'll very quickly be able to fine-tune your investment criteria as well. Okay. So yeah, so and then you think that, okay, this is a property that I like, but the cash flow is the negative cash flow is not something that I like. So there are a couple of levers, if you will, that you can use, right? And the first one is, can I go for a lower price? So I don't like, I can't buy this at 400,000, but can I buy this at 350,000? What does the cash flow look like? So here it's dropped down to now $260 and in negative cash flow per month. And let's say here, one thing that I should actually put here is the down payment. Let me do that right now. Okay. And the reason why this becomes important is that if you're playing around with the debt, then, so let's say if you want to increase your down payment from, okay, so you're paying down 30%. That means that that's another way that you can reduce your mortgage payments, but then it increases the amount of the down payment that you have to make, right? So now this cash flow has become negative $150. So there are some of those things, variables that you can play around. And of course, there's another thing of, increasing your monthly rate, rental income, but that's not in your hands, right? That's market driven. So then the question becomes, hey, for this price, can I buy or look at properties where the monthly rental income is maybe $2,400? So that's another way to look at it as you are expanding the zip codes or pockets of cities that you're looking to invest in. You can play around with these numbers to figure that one out. So I'll pause there. Any questions based on what you're seeing here? And there's one more aspect too, right? So this is a long-term interest, long-term loan. But then when you're going for short-term loans, you could buy a variable loan. You get a fixed payment for the first 5 years, and then you jump into a variable loan interest rate after the first 5 years. So for those type of loans, the interest rate could be lower. So it could be a 6.5%. But then for the loan term, it could be 360, but then only the first 5 years, it's a fixed 6.5, and then it becomes variable. So if you're changing that interest rate also, you can see that the mortgage payments decrease, right? And now you're eking out a small positive cash flow. So that's how.
Hi, my name is Jacob. Thank you for setting this up. I joined it late.
Okay.
But my question here is, like you mentioned about increasing the down payment, but that also comes at a cost of, like, opportunity cost too, right? Like, if you could invest that somewhere else. Yeah.
Absolutely. Yeah.
Especially now, like fresh is almost like 5%, so or more. So yeah.
Right.
So how do you so I mean, especially the current environment, how when I look at rental properties, like there is no way like I can break even or compared to another investment. So how do you determine that? Like, is it based on future value might appreciate and it will make more sense at that time, or how do we make a determination today, invest in real estate versus just keeping the money in treasuries, which is nearly risk-free? So.
Right. Yeah. No, that's a great question. And sorry, I didn't catch your name.
My name is Jacob.
Jacob. Okay. So Jacob, that's a great question, right? So there are few things to think about in real estate and in terms of the number of sources of return that you can get, right? And then the question becomes, okay, then if that's the case, then how much of cash flow is a good cash flow for me?
Right.
So especially for a lot of folks here in this on this call, they work in tech. They know pockets of cities around the US where you tend to find more appreciating markets, and so there are a few vectors to keep in mind. So first one is, yes, you have your monthly cash flow. Then the second source of income is that your debt is actually getting paid off, right? Every month when you're paying your mortgage. And then the third one is that when you sell the property, if you end up investing in a future property, then you're not paying the taxes. That's another source of appreciation. When I say a source of appreciation, what I mean is that
you don't pay
maybe source of equity for your next investment, right?
Right, yeah.
And then the last one that I didn't even touch upon is the just the property appreciation. So it's all these 4 or 5 factors that contribute to your 5% treasury rate that you get when you invest in treasuries versus what you get. And this is levered growth.
Yeah.
Right? So when oh, sorry, go ahead.
Yeah, no, I agree. Yeah, because we made we bought a rental property last year, and
congratulations.
Thank you. I mean, so far everything is good, but it's not. I can't say it's on positive cash flow. It's probably break even, or little less than that. So I mean, we are able to manage that because we are in tech, and we primarily bought it for like future appreciation. So just wanted to check with you on that.
Yeah. And that's the reason why what I tend to focus is on, folks who are working full time and who are working in tech primarily, because if you look at a lot of the other real estate investment advice, it's more catered to, I want to quit my job and then I want to lean on cash flow from my investment properties as my primary source of income. Then this advice doesn't work for them, right? So they have to be doing wholesaling, which is a full-time job in and of itself. So this is more for buy and hold type of investors who are looking at least at a horizon of 5 to 10 years timeline.
Right. Yeah. Got it. Yeah. Thank you.
Okay, no problem.
Yeah, I mean, we don't have any. It didn't meant to be a short term, so that's why short term it would have been a terrible investment at least.
Right.
Thank you.
Yeah, no problem. Any other questions? Okay, cool. So, where am I? All right. So again,
actually, if I can interject for one moment,
go ahead.
In your filter criteria, you mentioned no HOA. Did you find that having HOA makes it harder? I mean, in terms of, you probably can do interior without a lot of hassle, but the exterior is taken care of by the HOA. Did you find that generally HOA properties are a good argument against buying that property, or what's your experience with HOA? Have you never bought HOA like type of apartments or condos?
Yeah. So HOA is definitely, if you're buying a condo or a townhome, there is always an HOA. There's no doubt about that. And then for more recent buildings, and when I say more recent, even properties that were built in late 90s or early 2000, and especially if it's part of a community, there is an HOA. One of the rental properties that I have, which was my primary residence, which transitioned into a rental property, we do pay an HOA, but then it's a very small amount of HOA. So if the amount is small, that's fine. I mean, I would say it's okay. And if you're not planning to do anything major with the unit, then that's a major enhancements to the unit or renovations with the unit. I think you'll be okay.
I see. So you feel like HOA payment is the main detractor. It's not like rental restrictions or anything else to do with the HOA.
Right. Yeah, the HOA amount just becomes you have to weigh that into your math here.
I see. Got it. Thank you.
Yeah. Okay. All right. So the next one, I'm moving on to the second topic, which is tracking the deals, right? And this is a step that, again, as a first-time investor, I was not keeping tabs on what are the properties that I'm looking at, what are the properties that I'm evaluating. And what I have here is like a a very simple Excel here where I try to keep tabs on, what is the date, what is the property address. I insert like a property photo and what was the list price, and then what is the offer price. And there is one theory that I deeply believe in, which is, let's say you found a property that met your investing criteria. You took the time to evaluate the property and you come up with an offer price. So if it's within 25% of the list price, you should definitely submit an offer price, because you went through the whole exercise of putting in time and trying to figure out whether it meets your investment criteria, whether it makes sense for you and you like the property. That's something that you should definitely go and put in your offer price, even if it's lower than what the list price is. So a lot of times, especially when we are doing quick scroll of properties, it's like, okay, this list price doesn't make sense, I'm moving on. And then you go on to the next one. But if you take the time to figure out what is the offer price that works for you, you should put in the effort of actually making an offer. It might be low, but you never know based on the market conditions. The seller might be very motivated and your offer might be accepted. So keep that in mind. And the other big thing with tracking deals that I find is that as you are looking at different cities and looking at different zip codes and looking at different properties, having this sheet will really help you to become a smarter investor, right? You can figure out the trends, you can figure out what are the configuration changes, what are the properties there where you got at least some interest from the seller and things like that. So it's really powerful to have a mechanism where you're tracking your deals. And I'm a strong believer of, if you don't, if you're not tracking, then it's hard to measure any improvement. So always track what is important to you. So this is something that I strongly advise. I have a link here just with this template details. It's very simple. You can build it yourself too. Any questions on this one? Okay, I'll move on to the next one, which is finding an investor-friendly realtor. So this is the third topic that I mentioned. So as you're thinking about investing in rental properties, I call the realtor as your hero of your investment team, because if you find the right real estate agent, they could be the conduit to a lot of other folks that become part of your real estate investing team. I mean, saying real estate investing team might sound ominous. Oh my God, it's like, what? I'm not hiring a team here. But then there are a lot of folks that you're working with, right? When you invest in a property. So of course, it starts during the evaluation process. You're working with the agent, real estate agent. But then if you're working with the right one, they are pointing you to the right property manager. They are pointing you to the right mortgage broker. And your mortgage broker is an important partner when you're trying to figure out the financing for your property. And they typically, the charge for a mortgage broker is about 1% in transaction fee, but then the value that they give is enormous. For maybe not so much for your first property, but then as you're looking at investing in the future in multiple properties, they know exactly what your track record is. You don't have to keep submitting applications again and again for pre-approval. If you're directly working with banks, you end up doing those multiple applications. So it removes a lot of headaches. So I would definitely advise working with a mortgage broker. And again, this advice is for people like us who are working full time and then who are looking to invest in real estate, build wealth, but in the easiest fashion possible, right? So that's where I'm coming from. So these are my top 3 questions. So when you're looking for a real estate agent, right? And the first one is, do you invest in real estate? So when a lot of real estate agents that you will run into are trying to match buyers with their primary residence. And there are completely different set of attributes that go into when a buyer is buying the property for their primary residence. I'm sure if folks on this call, if you have gone through that process, you are looking for lot of emotional aspects when you're evaluating that property, not so much the financial aspects, maybe a little bit, but not as much. So that's why if the agent has themselves, if they're an investor, it makes a lot of difference. So that's one thing. The second one is ask them how many transactions that they have done in the previous year, in the last 12 months. That will give you an idea of the velocity of their business. And then the third one is how many of those transactions were investment properties. So you'll come across a big range. So people who say that, 95% of my transactions were for people who were buying primary residences and only 5% investment, versus some of them say that, it's 70% of them are were for investment properties and only 30%. So definitely take that into account. They must be doing, at least 40 plus percent, 30 to 40% in investment properties. That's a good benchmark, I would say. So any questions here?
I had hopefully a quick question. Have you worked with realtors from like Redfin or Compass? What's your experience with those?
Yeah. So for the investors, investor-friendly investors, so Redfin, I've worked with someone in Zillow, but then what I find is that they tend to be more of agents for primary residences. They haven't, at least the folks that I got in touch with, the brokers listed on MLS listings were mostly for primary residences or focused on that clientele, not so much on investor-friendly clientele. So the sources where I look at typically is BiggerPockets has a listing. So that's one place to go to. And then if you're trying to look at the agents that are doing most number of transactions in a city, then Zillow has this lookup. It's almost like a LinkedIn for agents, where you can go to Zillow and then look up how many transactions that they have done, their reviews, and all that information is available on Zillow. That's another place to go to and look at agents that are doing a majority of those transactions. And what I found is that 80-20 rule applies here. You'll find that there's just a handful of realtors who are doing big chunk of transactions.
Interesting. Thanks for sharing. Did not know the Zillow stuff.
Yeah. I don't have a link here, but sorry, what was that?
Yeah, Shanley. So one other question that I have is on the agents. Do you go with the regular agent, or based on the deals you just switch as you go? And also, follow-up question that is like, what's your experience on going with the seller's agent? I mean, that's a common, very kind of a practice in Bay Area, but generally, I don't know about that's advisable or not. I mean, for a primary home, we went with that approach, but then for the investment property, it was not the listing agent. But I think it would have been beneficial to go with the listing agent. So, any thoughts on that?
Just curious to know, Jacob. So, why is it more for the? Yeah, why is it beneficial to go with the seller's agent?
Sometimes if there's competition, then it just makes it easier for them to give the deal, because they have to give only one commission. That's what my understanding. And when we were buying on Prime a few years back, it was extremely competitive. I mean, even now it's competitive, but at that time it was crazy. So we were not getting any homes with we're going with our agent, and that's the only way I still believe we got the houses because we went with the seller's agent. But that's not for investment property, but for a primary residence.
Got it. Yeah. So so I bought my primary residence in the Bay Area a long time ago, 6 years ago, and we went with our own agent. And even in my investment property transaction, so even for commercial, we went with our own buyer broker. Yeah. And especially, so what happened, so I'll give you the example of Austin. So I found the broker through BiggerPockets and, went through and I spoke with a few of them. And the one that I chose finally ended up to be a really investor-friendly realtor, and he invests quite a bit in investment properties himself. So it was a good fit.
Okay.
And I got into their listings that they send out. So
Right,
you
right.
can actually talk to a couple of brokers that you like
Okay.
working with, and then and I'm really keen on making sure that the brokers get compensated. Like all the service providers on your team, they
Yeah.
it's always good to make sure that they get compensated well. So I try to keep it clean.
Okay.
So
Got it.
make sure that
Yep.
whichever listing comes through, whatever broker, I'm going with them so that they are getting compensated for that.
Okay. Got it.
All right. Any other questions? Cool. I will move on. So this is my last slide. So these are my favorite real estate resources. And do all of you look at Bigger Pockets website? So if you're
I
not,
do. Yeah.
if you're not, then that's definitely the best place to get a lot of information. So they have it's a publishing house. So they have a very active website, very active forums. So it's free to join. You don't have to pay anything. They have a paid membership also with some additional benefits. But it's a very active community. So any question you have, you ask there in the forum, and you can be rest assured at least 4 or 5 people are responding to your question. So it is a go-to resource for a lot of people in the real estate investor community. And they have a few different types of podcasts. One podcast that's targeted at only beginner investors, some of them for established investors, some of them, like one of them for women who are investing in real estate. So definitely check out Bigger Pockets. That's like your should be your go-to resource as you're trying to ramp up your knowledge of real estate investing. And these are some of the books that I found really helpful when I started to get myself more familiarized with the whole investing, real estate investing in rental properties. So One Rental at a Time by Michael Zuber. He's actually has anybody read this book? No. Okay. So he's from the Bay Area, and he was working in software sales for a long time. And while he was working, he and his wife started investing in Fresno. And a very interesting book. So he talks about how he grew it organically over a period of 5 to 10 years, and how he was, able to do that while still doing his sales job. And yeah, so I would highly recommend that. So his Michael's feedback or guidance is that have a target of owning at least 5 homes, and that will really. And it's not too ambitious. It's something that once you set a goal for yourself, you will find yourself working towards that. So I think that's and he's very down to earth, and whatever advice he gives is very practical. So I like that book. And then the second one is The Multifamily Millionaire by Brandon Turner. So it says multifamily, but what we talked about today was all about single family. And as you're starting your journey, I would say start with single family. That makes things easier. But then as you become more and more comfortable, start looking at multifamily also. So even though it says multifamily, this is actually catered towards small multifamily and single family homes. But so Brandon used to be with Bigger Pockets and has a lot of content, and there's a lot of great advice here in this book, frameworks, how to come up with investment criteria, what are the gotchas, and all that stuff. So really good book. And the next one is Long Distance Investing by David Green. So David Green is also a part of the Bigger Pockets community, but this book was somebody was saying something?
Sorry.
Okay, no problem. So this one was also a really good resource just to get familiar with all the different aspects of long distance investing. And I used it quite a bit when I was looking at investing in Austin. So that was really helpful. And I have a link to that 5-minute deal analyzer that we just reviewed. So that's it from my side. And if you want to get in touch, yeah, you can. FireLabs, that's what I started, and with the goal of how can I get more people excited about investing in real estate as a means to build wealth? So that's what I have. And then there's a FireLabs podcast where I post information more around tips and tricks around investing. So give it check it out. So that's all I had for today. I'll open it for any questions as you have. You guys have been pretty good about asking questions as we went along. But if you have additional questions, I'm happy to answer.
Probably this is out of the box question, but have you invested in anything other than like a traditional real estate, like something like ag property combined with Airbnb sort of things, or have you focused mainly on commercial or single family or multifamily?
It's the latter, Jacob. And
Okay.
I've toyed with the idea of Airbnb, but I figured that it becomes your business model is no longer just rental property investing. You're entering hospitality business. And
right, yeah.
So I looked at a couple of numbers, but the property management fee increases significantly. So we are talking from 8 to 9% all the way up to 35%, jumping up to 35%. And then you're so reliant on here when you're in a buy and hold, you are just reliant on your property manager, right? When you enter into the short-term rentals, you're reliant on Airbnb, you're reliant on your property manager, you're reliant on your guest to give you good reviews.
That's true.
So there were so many, it became very complex very quickly. And if I know people who love the short-term rental models, and I love, whenever I travel these days, I'm using Airbnb so much. I love the experience of Airbnb travel, but it just wasn't a fit for me.
Right. Okay. Got it. Okay. Thank you. Yeah. We were analyzing a very unique deal. So I don't think there's any book that I can refer to that will give me sufficient information. Yeah. We'll have to do it and see it, like, if it works out. That's always I don't think there's any tailored advice that I can get for that.
Okay. Yeah, if you want to chat offline about it, I'm happy to chat more. In the last few years, in the process of my own journey into investing, I probably analyzed at least 100, 200 properties. So it just comes very quickly and easily. So but otherwise I'm more of a buy and hold and leaning more and more towards multifamily, but otherwise single family and multifamily are my primary
okay.
models.
I might reach out to you on this, like if it's not too much trouble.
Ping me. Cool. We are 5 minutes over. Any other questions?
I had a question on property management. Based on your experience out of your portfolio of properties, do you have them all under property management? Do you manage some of them yourselves?
I don't manage any of them myself, Daniel. Between my job, family, and the downtime that I want, I cannot manage. That's what I figured for myself. But like I said, I know folks who do manage at least small portion of their portfolio. That wouldn't work for me.
Yeah, and probably depends upon the portfolio size as well, right? Like, I have a single family which I can easily manage, but multi-family and all of that, probably going to be more difficult. And to a large extent, also the tenant intersect.
So I have
Jacob, you dropped off. He dropped off. Okay, Jen, tell me.
Of course, is it like I'm a little confused when people say like, is the property in LLC? Is that something that you do or?
I would say don't even think about it. Don't even worry about it. You don't need to create an LLC to have a property. No.
Okay. Yeah, because I keep on seeing that in the channel sometimes, and I'm wondering, is that something that's a lot of people do, or?
So, Jen, what's the corollary that comes to mind when I think about starting an LLC for buying real estate is that if you're starting a business, do you want to spend the money in getting or time in getting a fancy business card and in getting a fancy accounting software, right? That's not important for you. And same thing goes with when you're buying rental properties, make sure you're spending time on looking at enough number of deals and listings, right? That's what will get you to finding the right property rather than spending time on all these admin stuff. This is, there's money activities and non-money activities. Creating an LLC and all that stuff is non-money activities, so don't focus on that.
Okay, thank you.
You'll get, when you get there, right, you'll figure it out. But in the initial stages, once you start thinking about it, it just becomes overwhelming. You're like, oh my God, I find it painful to file my own taxes. Now, do I have to create an LLC and file taxes? Don't worry about it. You don't need it.
Okay, thank you.
Yeah. All right. So thanks, everyone.